These are 6 common business structures for property development, and pay attention if you're a wannabe property developer. Now, first of all, you noobs will be asking, what is property development queue? Well, basically very simple. It's when you and another mate or your family or spouse purchase a piece of vacant land in the objective to manufacture growth. And there's 2 simple ways to manufacture growth, which is to put a building over here, or you can hold onto it, which is also known as land banking, and then reselling it at a higher value. Now, before you start off to buy a vacant piece of land to develop on it and manufacture growth, the first company structure to consider is setting up a company, also known as a proprietary limited. And it's a very proper setup for most developers, even wannabe or seasoned developers, because it creates a separate legal entity from yourself, which offers you limited liability protection to you and the other shareholders. To give you an example, instead of owning the vacant piece of land to build on top, you and your spouse or your mate won't put it under your personal names. You'll put it under a company called ABCD P2A Ltd, or whatever company you name it. Now, in a case where someone decides to sue you in terms of the pursuit of legal damages, in terms of, for example, they tripped on your vacant piece of land while you're building it, or whatever reason that they want to sue you on, if you purchase this vacant piece of land under a personal name, they can go after all your assets, bank account, your wife's jewelries and undies. But if you're a smart cookie and you watch this TikTok video and go, hey, I'm not going to buy under my personal name, I'm going to set up a PTY Ltd company, which means if someone sues you and goes after your money and your wife's knickers, the person that decides to sue you, or the creditors, for example, they're giving you money and you haven't paid it back, they can only sue the company and whatever assets within this company. They cannot go after all your assets under your personal name. For example, you have a car, you have a house, they can't touch that because it's protected under this company. And also in terms of tax treatments, in terms of the income derived from this manufactured growth, in terms of the 21 to 22 financial year, if the company, which obviously will be earning less than $50 million, will be only taxed at 25%. But mind you guys, I'm not just saying there's all pros to setting up a company, because there are different tax rates in terms of just using the company to hold on to the property to trade. For example, you buy and then you sell, versus using a company to manufacture growth and then you decide to hold this for rent. There are different tax rates. And sometimes using a company might not be the best structure if you plan to hold on to that property for a long-term period in terms of renting it out. Now, a second setup, which is also very popular, is called a unit trust. And basically, the trust is divided into units. Say if you're doing a development where you're buying a vacant piece of land and you're using a unit trust, the trust could be split to different people involved in the project. So you have your mom, your dad, your brother, sister, whatever. You could have your mate, your mate's girlfriend, whatever. They all hold their own individual units. Now, the pros of using a unit trust versus a company structure is that these units can be bought and sold. For example, old mate dad over here decides to just jump in for the first half of the development and decides to sell it to his brother for whatever reason to replace him. He can actually do that and not upset the whole structure of the development. In addition, the popularity of a unit trust is for usually small projects that require more funding, because you can add more units at the end and sell these units to additional investors into this project you're planning to do. And another perk of a unit trust is that each unit holder that has a unit trust, you don't pay tax on the unit trust. So therefore, as a unit trust holder, you can distribute the income from the unit trust to different beneficiaries. Now, that sounds like a whole pile shit of jargon. What I really mean is that if, for example, you as a unit holder, after the sale of this vacant land, after manufacturing growth, you derive 100K, you can actually distribute this income. If you have your spouse over here, you have your brother, sister, whatever, you can distribute that so that you're not just paying 100K under your own personal name. Now, before this video blows out to a 10-minute video, the other structure, the third structure for a development, is through a family trust. This is also known as a discretionary trust, and the word sells it. It's a discretion over how to distribute the trust income and capital to its beneficiaries, very similar to this, except it has a difference where it doesn't hold units, and it's usually for a family. The fourth setup for a development company, if you're setting one up, is the partnership agreement. Now, generally, I wouldn't recommend this setup when you're doing a development company because there is unlimited liability, whilst for a company there is limited liability. But the only advantage of this is that it's very easy to set up. One main advantage of using a partnership structure is that the partnership's income is not taxed at the partnership level, but rather at the individual partner's level. Also, a big con is that each partner is personally liable for the debts and obligation of the partnership, which means if your old mate Sam got into a lot of debt, well, you also incurred that debt because you're part of that partnership of this development. The fifth setup, which is quite common, is called a JV, which is a joint venture agreement where two people enter into a JV. And it's sort of like a partnership agreement, whilst it's not a partnership because there's no partnership agreement drawn up. It's through a joint venture agreement, and basically it's very simple. Basically, it's a very loose agreement between you and some other mate, and then this person agrees that they'll come in with the capital and all that stuff, and this person comes in with the brains and the knowledge or the hookup of the tradies and contractors, and basically both person signs and handshakes and done. Very last structure, which is very rare and I don't recommend it, is a self-managed super fund structure for a development. And usually why you wouldn't use this is because it's a single acquired asset. You can't make changes to the asset while you're purchased under SMSF. There are a lot of compliance concerns when buying a property for development purposes through an SMSF fund, so I don't recommend it. So guys, those are the 6 structures for newbie wannabe developers. Jump in the comments, let me know what you think about them.